Hey guys, it's Suerte Panda. Welcome back to the channel. So in my last video I talked about delta neutral trading, but this time I thought it might be more interesting to see a TradFi options platform versus a actual DeFi options platform and see what the differences are. So let's get right into it. So I wanted to compare a Strangle from Tastyworks on Microstrategy. I'm on portfolio margin, and I wanted to see. I was trying to find like an apples to apples comparison, but there's not really anything I can for like crypto. They do have Tastyworks does have crypto, but they don't have any options on it. And unfortunately, I live in an area where crypto isn't even enabled yet, so I can't really do much on there yet. And they do have Tastywork. Excuse me. They have a CME futures for Bitcoin, but I think it's a little too expensive for most people's because the future is worth of 5 Bitcoins. So that's at today's prices, that's like $150,000 roughly, probably a little bit more at the time of this recording. So for most people, it's not. I don't think it's doable. I think that the next closest thing is is MicroStrategy. It's mostly Bitcoin anyway at this point, and it's probably one of the few um, products that I'm comfortable trading options against. So I just wanted to show you what that looks like and how it might compare and contrast. So let's take a look at uh, some of the math against it. So I wanted to find something where it has like both Tastyworks and the Opyn protocol. I hope I'm pronouncing that right. It's OPYN, so I'm assuming it's pronounced open, but who knows? So I noticed they both have expiration cycles at on August 27th. So I just wanted to kind of to go with that. So far the buying power effect. In my last video, I noticed like the for certain products it looks a little low, but this looks about right for MicroStrategy since it's not as liquid as say like the SPY ETF. So this I'm a little bit more confident in this number this time around. So at the time of this recording, it's roughly 34 days to expiration. So I'm selling a roughly uh, one standard deviation strangle. So at today's pricing, it's around at the 660 call strike and the 425 put. And for the 600 for the call, I'm basically collecting $1,000, 820. Assuming I'm just hitting the bid. I'm not even waiting for the mid price. I mean, just for the purpose of this video, because it's just for educational purposes. Not financial advice and all that kind of good stuff. For the put, I'm collecting $1,400, and that so in total, I'm collecting $3,220 up front. Hopefully, if it expires cleanly out of the money, that'll get me to 13.89% return. If I'm really greedy and uh, I just want the whole try to gamble a little bit. Like I'm assuming it won't go past the 660 call strike or going down past the 425 put. But if I want to be a little bit more cons- conserv- conservative, where I want to follow the Tastyworks trading guidelines, where I'm just gonna close it out at 50% profit, or like within 20-ish days, and this way I can just collect a 6.94% annualized. Um, and again, like if I annualize this, this gets me to 124%. Um, depending on how fast I can cycle back into like a similar trade. Again, this is results may vary. Um, and again, I'm making an assumption that it for the Tastyworks scenario where like if I close it out, like roughly 20 days that or like I can get it at a 50% profit. You know, if I keep cycling back and forth through multiple cycles. Um, Again, these are optimistic scenarios. Like let's say like for example, if it goes past the 660 call strike, I'm gonna be kind of angry. I'm gonna have to try to buy it back and sell a like a higher strike price to kind of compensate myself on the call side, and then I'm rolling up puts. But I don't want to get too much into that. Uh, like maybe if you guys want, like I can make another video, like if just for like strangle management, because like this is being like really optimistic that like the stock like stays between 660 and 425. But it looks like Bitcoin's on the move again, so most likely, if you were to put on this trade, the 660 call strike could easily get breached again. Because if it runs up, let's say Bitcoin runs up to like 40,000 and then 50,000 and 60,000, you're gonna be crying. Because MicroStrategy is gonna go up along with the ride, and if it goes past like the 660 call strike, it's really painful. Um, just from personal experience. So just moving right along. So let's go on to like the open protocol. Um, right now, yeah, as of right now, like I probably wouldn't be too comfortable trading this, but it does look okay from a like a visual perspective. Um, I'll talk about more about this I guess like in like the conclusion area. So basically, the good thing about Open, you can trade something besides Bitcoin, and I wanted to find something a little bit different. So like if you wanted to trade like Ethereum, which is like another coin that I think a lot of people could be interested in, because right now there's only I think there's a grayscale ETH. It's not really an ETF. It's kind of like an ETF. It's basically like a trust. But there's no options on there as of yet, and I don't know when that's gonna if ever. So open protocol could be like a good option for you if you want to like avoid like a centralized exchange option. Let's see what else. There's also other protocols, so I guess like I'll probably cover that when I get a chance because I think there's also hedging. And there's something that goes on like it's another protocol that layers on top of Open where they're trying to do automated uh, option selling called Ribbon Finance. I'm not too keen on that yet, but again, it's just like another option. So like as you can see right away, there's not a lot of like strikes available, and there's also like the option like the different amount of expiration cycles isn't like that great. But we're still early days, so I wanted to cut them a little bit of slack. So like like for the open protocol, you can't really sell like a naked strangle because if they for most DeFi protocols, like they want you to be uh most places they want you to be over collateralized because like in order to be permissionless or like to cut down on the number of worries, like if people are over collateralized, prices can move a bit, but you could still be comfortable with the counterparty risk because you like the person on the other side, you want to make sure that like if you're making a trade, you want the other person to be able to either pay you back or like to have like some comfort that there's like some actual capital on the other side, like in order to even do the trade. So let's just go with like unfortunately the closest I could find to like a one standard deviation strangle is at the time of this writing the 1800 put strike, and then the 2800 call strike. They're it's not exactly one standard deviation. They're like like roughly 20 deltas. But I just wanted to show you how like the math works out. Again, it's on the August 27th expiration cycle. Again, 34 days. The 2800 call gives you like that's where like most of the money is. So you can see there's like just based on like the math, like the market is seeing like more risk to the upside. That's why you're collecting, you know, or three little over like $3,000 up front, and like people aren't afraid that it's gonna go to the 800 1800 put strike. You're only collecting like 173 bucks, and you're collecting to 3,400 in total. Um, and if you go through the math, the math is really wild. Like in the greedy center, you're collecting almost like 91, like close to 92% in the greedy scenario. And if you wanted to do like a Tastyworks similar methodology where you're trying to close it out like at 50%, you're still collecting 46%. And then like if you annualize this, you're getting 819% in the greedy scenario and almost 800% on the Tastyworks kind of style of trading. Again, its results might vary, and this is like the optimistic scenario, and again, just looking at the premium, there's a lot of risk to the upside. So I think a lot of people are expecting like the cryptos to really like go on like another bull run. And there's also something interesting to note. Like their version of like the buying power effect, it's really like it's not quite the same as Tastyworks, their margining system. Like they have their own like margining, and the call side, actually instead of like USDC or like a US dollar collateral on the call side, they actually want you to be uh, you actually have to put up like one ETH as collateral, depending on how many um, options you want to sell against it. And I think that's actually pretty smart. So basically, this isn't this isn't like a true strangle. It kind of be like a covered strangle where you're combining a covered call with a cash secured put, and that's why like the buying power is basically um like almost like the equivalent of like two ETH. So basically, again, if you work it out like logically, like if like the price goes below like the $1,800 put, like if you're selling, you're basically obligated to buy at eight like $1,800 put. So basically, you have to put up $1,800 to buy ETH. And for me, like if I'm selling like that put, I actually wouldn't mind buying ETH at $1,800, and that's why I wouldn't mind selling the like this particular put. Um, and then on the other side, the way it works is since it works more like a covered call. So at the time of this recording, like ETH is like roughly uh like 2000, and actually um it's actually closer to like 2100. So let's say if you put up like one ETH up as collateral, let's say like the the uh the price moves past 2800, let's say like it goes up to 3000, you're kind of locking in your profit at only $2800 level. So depending on when you bought ETH, Ethereum, and then you're selling the $2,800 call against it, that's kind of your maximum gain. And then also factor in that you're collecting like $3,000 of collateral, excuse me, of premium upfront. So like in that sense, like if you look at like the premium collected versus like the margin that you have to put up, it's more capital efficient. Um, in that sense, and that's why like the percentage returns look so much more than let's say when you compare it against the um, like MicroStrategy, because like MicroStrategy is a more expensive product. So like I mean it's kind of not fair because like there you have to put up more capital against a against like MicroStrategy, because MicroStrategy, if you wanted to do like 100 shares, um, at the time of this recording, it was like like around $53,000 product versus a ETH, which is like if you're just doing one, it's like 2,000, 2,100, like in that range, that type of product. Um, so it's not like, again, it's not exactly like a clean apples to apples comparison, because you're putting up less. If if you wanted to do like a true apples comparison, you have to sell like the equivalent amount of of dollar value of ETH. So you probably have to do like 20, between 20 and 25 ETH, and then that's gonna multiply like the buying power effect um, by almost like between a factor of 3 and 4, and that'll give you like a more of a true um, apples to apples comparison. Um, so then like after you do that, then like the numbers like will start to, like the returns won't be as good because you're putting up more capital. Um, but anyway, let me move on. There's a risk of like Opyn because they were hacked last year. And then like if you wanted to read more about it, you can go to like this particular link on DeFi rate. Um, but they did offer a quick resolution, and they did reimburse like people that did lose money. So that's probably one of the good signs of like a reputable like protocol. So I still have like hope that like in the future that they'll that they'll that they'll have more strikes in the future. Um, like I'm saying, like it has limited expiration cycle, but it does offer weeklies, so there's more chance, like there was more chances for you to sell premium. And I would like to see like more strikes, because right now there's like there's only three at that expiration cycle at the August 27th. And right now they're still on the Ethereum mainnet, so the transaction cost can be, you know, depending on when you transact, um, it can be quite expensive. So let me see. So like this would be like my wish list, like definitely more explorations, and then definitely more strikes, and I would like to see like lower transaction costs. Like hopefully maybe they'll move to like a layer two or maybe like a side chain or something. Um, so like for as of right now, Tastyworks versus Open, it's a no contest in terms of like number of features and number of products, and then in terms of usability. Because like right now, like the Open protocol, you have to connect to a MetaMask wallet, and some people aren't even at like that stage yet. So in terms of like I guess like usability, it's still the winner. The winner right now is Tastyworks, but in terms of capital efficiency and profitability, I think in the future, like Open could be the winner. Um, so let's just say, like for example, if they can open up like more strikes and they can open up more products like besides Ethereum. So like for example, if you wanted to sell like I would really like to sell like options and on like something like Uniswap or like Aave or Curve or like any one of those protocols. Um, there could be like opportunities to like get a lot of like good premium, and then at the same time maybe like um buy like cheaper products, um or like to maybe just like hedge your overall portfolio. As much as I like Tastyworks, there's still a TradFi financial services company, and they're subject to regulations and all that kind of stuff, and KYC and etc. So let's go through the caveats. So like to really get like the most out of Tastyworks, you really need a like a portfolio margin. Um, and it's $175,000 account to start. Um, and then again, like when you're trading on margin, like their system, like they call it like the buying power effect, and like during big moves, um, you could be required to put up like more cash to support your position. So just be careful with that. Um, and then open like right now they still have limited strikes. And then again, like options trading isn't for everybody. So both methods can still get a while to get used to. But I'm really excited, like for protocols like Open. Like I kind of hope that there's more like competitors in the future. This way it forces each protocol to kind of like really work hard and like to work through um like the protocols to make it more robust so that in the future it can attract like more liquidity. Because like so far like the derivatives, like on some of the like more centralized exchanges, I'm a little hesitant to touch those just because I don't know how well they're backed. But so like in terms of which is better for now, I would say like especially I've more money to put to work. I would say TC Works portfolio margin could be an option. Again, it could be really risky. So watch out for that. It's high return, high risk. Again, it's not any type of financial advice. I'm just showing you guys like what's out there. And then also, um, I think in the future, something like Open, um, like right now, it's good for like if you want to just like play around, just to get used to the protocol. Like I would just like risk like small amounts. Um, and then like there's also like for something like Open, if they don't program it correctly, there could be like all types of like contract risk, like exploits and rug pulls and all that kind of stuff, and hacks. But something like Open, I think for the future, like is potentially something interesting to do. So say like you don't want to like buy Ethereum at like a certain, like right now, like let's say like Ethereum, you still think it's a little bit risky. You don't want to buy it at 2000 or 2100. If you're willing to do a cash secured put at a like a lower strike, you can collect some money up front while you wait for like Ethereum to maybe hit that strike. But if it doesn't even go to that strike, you get to keep the premium. So it's something where I think like if we can take like kind of like the good stuff from like TradFi and like port it over to DeFi, but at the same time making it permissionless, um, making it a little bit more safer. So you have to go through like all these like the risks from like TradFi because like let's say like even if, as much as I like Tastyworks, let's say in the future like they get taken over by unscrupulous people. My money is at risk. Like I even though there's like SIPC like insurance, let's say something bad happens to them. My money is could be tied up for a while, like while I have to get a lawyer, probably have to go to court and like file some claims to get some of that money back. Um, Now I'm saying not saying like that open protocol is like super safe. Obviously it's not because like in the past, like they have been hacked, but they did do a good thing where they reimburse like their customers, so that I like. Um, and these type of like exploits, it's bad when it happens, but like it makes like the protocol stronger because in the future when they keep patching, they'll learn from like their mistakes and become stronger. But I'm kind of like optimistic about the future in general, especially for DeFi, and and I hope like this content is like a little bit different, and I hope you enjoy it. So thank you for watching, and have a great one, guys.